Most Canadians overpay taxes by $3,000 to $5,000 every year, and they have no idea that it's happening. You've got 6 weeks left to fix this before 2025 ends. Otherwise, you're screwed. Look, I'm Lakshay and I'm a CPA. I've saved clients tens of thousands of dollars by using CRA strategies that they want you to actually use. These aren't just some sketchy loopholes. They're sitting right here in the tax code. Rich people know them, business owners use them every December, and now you will too. Here are 5 moves that are all legal yet all powerful. Number 1 is RRSP versus TFSA. Number 2 is organizing receipts. Number 3 is income splitting. Number 4 is installment payments to avoid nasty surprises. And number 5 is asset purchases that can save you a lot of money. So what are you waiting for? Hit subscribe because I dropped weekly tax tips that usually an accountant will charge $150 per half an hour for. So first up, we have RRSP or TFSA. Most people screw this up by either paying thousands of unnecessary taxes or missing out on tax-free growth completely. The answer isn't what your bank tells you. Let's break it down. Here's the truth nobody tells you about RRSP versus TFSA. Most people are putting money in the wrong account and losing thousands without realizing it. Your income determines which one wins. RRSPs for 2025, the maximum contribution is $32,000 roughly, or your 18% of last year's income. The deadline to contribute to this account is March 3, 2025. For TFSA, it is actually December 31st and the contribution room is $7,000 per year. So which one saves you more money? It depends entirely on what you are earning right now. If you're making under $55,000, TFSA first, no question. Why? You're in the lowest tax bracket. The RRSP tax deduction doesn't save you much money, but TFSA withdrawals are tax-free forever and including all the growth. Plus, you can pull money out without consequences if life happens. If you're earning between 55 and 111K, this is where it gets interesting. Max out your TFSA first, that's your $7,000 for 2025, then dump the additional savings into the RRSP. Why? Well, the RRSP deductions start getting valuable in this tax bracket. Between 111 to 173K, RRSP becomes more priority. Making 111 to 173, RRSP becomes your best friend. The tax deduction in this bracket is serious. You're saving about 30% on every dollar contributed. Max that RRSP first, then if you've got extra cash, throw it in your TFSA. You're in the wealth building mode now. The RRSP deduction drops your taxable income significantly. Earning over 173K, RRSP all day. You're in the highest tax bracket, which is 43% and plus in Ontario. So every RRSP dollar will cut your tax bill in half. That's insane value. So max out your RRSP with this $32,000 that you have swimming around. And if you have any leftover, throw it in the TFSA. This is how wealthy people legally shield income from taxes. You just optimized your RRSP and TFSA strategy. Now let's talk about the dumbest ways Canadians throw away money. Disorganized receipts. You spend the money, but you can't prove it, so you can't deduct it. The average Canadian loses $1,500 plus annually in legitimate tax deductions simply because they can't find their receipt when the tax time hits. I've seen it happen too many times. The business owner claims $8,000 in office supplies, the CRA audits them, and they pull out a shoebox of faded, crumpled receipts, some missing dates, some unreadable. The result? The entire claim gets disallowed, with penalties and interest. That deduction just turned into an extra $3,000 tax headache. Here's how to fix this in 3 simple moves. Move number 1, business only account and credit card. Get a separate business card and bank if you're self-employed and have a side income. Why? It automatically separates business from personal expenses. Your December credit card statement becomes instant documentation for deductions. Mixing business and personal, you're making tax prep 10 times harder than it needs to be. Plus, if CRA audits you, clean separation makes life way easier. So pro tip is use one card for business, a different card for everything else. Simple. Number 2 is making notes on the receipts. See, I have a small note at the top just to remind me what this dinner was for and how much we paid, plus who was it with. This actually helps CRA keep track of personal and business expenses. This way, this over $200 restaurant bill, just write it on the back It's a client meeting with John Smith project discussion. The $200 software purchase? Note, accounting software subscription QuickBooks. Without context, the CRA can reject the deduction even with the receipt. Move number 3 is go digital. Paper receipts fade. Thermal paper from stores gone in 6 to 12 months. Then you're screwed. Take a photo immediately after every purchase. Use your phone, it's always with you anyway. Apps like Dex, Receipt Bank, or even just Google Drive automatically organizes photos by date. Upload, done. The CRA accepts digital copies as long as they're legible. No paper storage, no fading, no lost receipts in random drawers. Set a reminder. End of every day, snap receipts and upload. Okay. You're maximizing retirement contributions and tracking every deductible expense. But here's a strategy most Canadians completely ignore. Income splitting. Legally shifting income to family members in lower tax brackets to drop your family's total tax bill. This is how wealthy families save tens of thousands annually. Stay with me, I'll show you exactly how it works. Here's the core idea. You earn $150,000 and pay 43% tax. Your spouse earns $40,000 and pays 20% tax. If you can legally move some of your income to your spouse, that money gets taxed at lower 20% instead of the 43%. Same family income, way less total tax, and it's completely legal if you do it right. Income splitting works best when there's big income cap. One spouse earning significantly more than the other. Corporate income splitting. If your business is incorporated, this becomes even more powerful. You can pay dividends to your spouse and your adult children who are in the lower tax bracket. The income gets taxed in their hands, not yours. Let's say you're making $200,000 from your corporation. Instead of taking it all dividends yourself at the highest rate, you split the $100,000 with your spouse who has no other income. Result, you pay tax on $100,000 instead of $200,000. Important. The CRA has tax on split income that prevents the abuse. Family members receiving the dividend must either be 18 plus and actively working in the business, be legitimate shareholders with real involvement, meet specific exemption criteria. Don't just pay your teenage kid $50,000 in dividends for doing nothing. The CRA will crush you with the highest tax rate. Here's another powerful move. Contribute to a spousal RRSP instead of your own. Let's say you make $100,000 and your spouse makes $45,000. Contribute to a spousal RRSP, you get the tax deduction now at your high rate, but when your spouse draws in retirement, it's taxed at the lower rate. This splits income before age 65, which most pension income splitting can do. Don't withdraw within 3 years of contributing or the CRA attributes it back to you. I suggest talking to your accountant before December 31st because the proper setup will take some time and documentation. You're now optimizing retirement accounts, taking receipts, and potentially splitting income to lower your family's tax bill. But here's what catches most people off guard. A massive tax bill next April, plus CRA interest and penalty charges because they didn't make installment payments. What installments are? You have the option to pay two $20 bills or $100 bill at the end of the year. What would you prefer? I'm sure you would prefer the smaller amount, which is cyclical but well controlled. This is the reason why installments work best. Installment payments are quarterly tax payments you make throughout the year instead of getting slammed with a one huge tax bill at April 30th. They are required if you owed more than $3,000 in taxes in the previous year. Think of it like this. Employees get taxes deducted every paycheck. But what about self-employed people, contractors, and rental income earners? You need to do it yourself quarterly. You probably need installments if you're self-employed, you have rental income, you have significant investment income, or you work multiple jobs. CRA will send you installment reminders if you're required to pay one in February for March, June payments, another in August for September, December payments. But here's the catch. Just because you didn't get a reminder doesn't mean you're off the hook. If you meet the $3,000 threshold, you're legally required to pay. Mark your calendars, 4 dates every year: March 15th, June 15th, September 15th, and December 15th. If you miss a payment, CRA will charge you interest from the date moving forward. It's around 10% annually. Make all 4 payments on time, and when April 30th rolls around, You've already paid most of your taxes. So no surprises, no massive lump sum, no stress. Alright, you're staying ahead of the CRA with the quarterly payments. Now let's talk about final year-end move. Timing asset purchases to maximize tax incentive before December 31st. If you're planning to buy a business vehicle or equipment, timing matters massively for tax deductions. Buy before December 31st and you could write off way more than you think. But the window is closing. If your business needs a vehicle, which is zero emission vehicle, you get an insane treatment for CCA. The government has created enhanced first year CCA, which is a fancy term for depreciation, to encourage businesses to go electric. Here's the phase out schedule. 100% write-off if purchased before 2024, that ship has sailed. 75% write-off for 2024 to 2025 this year, still available. 55% write-off for 2026 to 2027. Back to regular 30% from 2028 and onward. Buy an eligible electric vehicle before December 31st, 2025 and you can deduct 75% of the cost immediately. Important, the vehicle must be available for use before December 31st, 2025 to claim the 75% write-off. If you let's say order now and take delivery in 2026, unfortunately, this won't work. You will only be entitled for 55% rather than 75% deduction. So let's bring it all together. You've optimized the RRSPs and TFSAs, organized the receipts, split income, made installments, bought assets, and now you're not just filing a return, you're running your finances like a pro. If this video saved you money, smash that like button. It helps other Canadians find this information before it's too late. Subscribe for our weekly tax strategies that most accountants charge hundreds of dollars for. Hit the bell so you don't miss out updates on rule changes. Drop a comment below with which strategy you're implementing first. I read every single one of them and I'll answer questions. If you need help with your specific situation, well, you have the option to book a free consultation with me. And if you want, we have a free tax loophole guide sitting in the description and pinned in the comment. It shows exactly how Canadian business owners can legally reduce tax bills and how you can do the same. Don't wait until April wondering why you owe so much. Take action this week. Your future self will thank you when you're getting a refund instead of writing a check to a CRA. See you in the next one.